Hey folks, welcome to another product review at Finominal. Today we're going to have a look at the largest hedge fund ETF trading in the US, which is First Trust Long Short Equity ETF, which manages around $90 million and charges 95 basis points per annum. Now, there is no intuitive benchmark for an equity long short ETF that is tradable. You could look at private indices from HFX, Eureka Hedge, and kind of like folks like those. So what we're going to do is we're going to launch straight into the drivers of risk and return by using our Know Your Factors tool. And we're going to kick off with the factor exposure analysis, looking at equity factors. Now, what we do see that FTLS has a portfolio comprised of long and short positions in US stocks that are selected on earnings quality. So what we would expect is positive exposure to the quality factor, which we do see at times, but not on a consistent basis. And overall, looking at the factor betas in this period from 2016 to 2022, we do see that the factor betas were all over the place. So there's no consistent factor exposure within this product, which can be good or bad sign. It could be a bad sign in the sense that the manager doesn't know what he's doing. It could be a good sign that the manager does know what he's doing and he's just shifting his portfolio frequently. And so it doesn't have consistent exposure to quality or to value or whatever other style factors you can think of. Now, what's perhaps more interesting, that if you look at the asset class exposure of FTLS, we can see that there is a beta between, let's say, 0.4 and 0.6 to the S&P 500 on average. And that's exactly what we would expect from a long-short equity hedge fund, that it does provide exposure to the stock market, but at a lower level, because you have your short positions that hedge you against downturns or declines of the stock market. Now, the problem that we found in our research over the last few years is that a lot of long-short equity hedge funds don't do much. They theoretically should provide alpha via stock selection, but in practice, they're just diluted equity exposure. And we can see that is the same case for FTLS by using a tool called the Time Machine, which is almost like the most simple replication as you can think of. So what you can see over here is you can see the performance of First Trust Long Short Equity ETF in the period from 2015 to 2023. And you can see a portfolio comprised of the S&P 500 and cash. And what we do is we kind of say, hey, can we replicate the portfolio of this ETF simply using stocks and a bit of cash, assuming the same volatility? And surprisingly, you can. So with a simple replication using 64% SPY, which is a proxy for the S&P 500, and 36% cash, non-interest, so doesn't generate any return, you effectively have the same return and the same volatility. And we can see that. So you see the volatility has been 11.45%, and the same for the replication. Now, this is not good for FTLS because effectively it means that it doesn't generate any value, doesn't generate any diversification benefits. It simply represents diluted equity exposure, which an investor can get by simply selling down equities. So, but let's try to quantify that, right? Maybe there is something in this product that we don't see by doing such a simple analysis. And let's go to the diversification booster to see if indeed there are no diversification benefits. And so the first thing that we can see up here is that the correlation to the stock market was 0.85, so very high. And we can see that the upside beta to the S&P 500 is lower than the downside beta. And that's not attractive. This effectively means you gain or you lose more when the stock market declines that you gain when it goes up. Now, we can quickly see in terms of, does this product generate any diversification benefits? And the product has about 10 years of history, almost. You can see the S&P 500 generated a Sharpe ratio of 0.66 during that period, which is very high compared to history. If you go back over multiple decades, it would drop to 0.3, 0.4. But adding a 25% allocation to FTLS would have only increased the Sharpe to 0.68. And that's marginal from our perspective, which again highlights that this is kind of like a just diluted equity exposure. And we can show you like a more diversifying strategy where we look at CTAs and use DBMF as a proxy, just to demonstrate that there are diversifying hedge fund strategies that actually do offer significant diversification benefits. And here you can see how the Sharpe would have increased from 0.62 to 0.74. Now, that's more meaningful, more significant. So we're going to leave it at that. So for 95 basis points, which is what FTLS is charging, it does seem quite expensive given that it doesn't generate much diversification benefits, and investors can simply replicate that product by having an allocation of 60, 55% to the S&P 500 and holding the rest in cash, or simply selling down the exposure of an equity portfolio. That's it. Hope this was helpful. Have a nice day.